Funds transfer pricing, or FTP, is a financial management tool used by banks and financial institutions to measure the profitability of different business units, products, or branches. It works by assigning a cost to the funds used by a unit to lend money and a credit for the funds it provides to the institution. FTP helps ensure that each part of the bank is fairly evaluated based on its contributions to the bank's overall profitability. Here's how it works. Banks operate by borrowing and lending money. For example, a retail division might take deposits from customers at an interest rate of 2%, while the corporate lending division might lend money to businesses at 6%. The difference, or spread, is the bank's profit. FTP ensures that the cost of those funds, in this case, the 2% deposit rate, is appropriately allocated to the division using the funds, the corporate lending team. FTP assigns a transfer price to internal funds based on factors like market interest rates, the bank's overall funding costs, and the duration of the funds use. For instance, if the bank determines its cost of funds to be 3%, the corporate lending division would be charged 3% for using the money, and the retail division would receive credit for providing funds at that rate. The benefits of FTP are significant. It ensures transparency by showing how much each division is contributing to or costing the bank. For example, if one branch generates deposits but incurs high costs to acquire them, FTP makes it clear how profitable or unprofitable that branch is. Similarly, if a lending product generates large profits, FTP ensures those profits are attributed to the correct team while accounting for the cost of the funds used. FTP also helps manage interest rate risk. By aligning internal pricing with market rates, the bank can make informed decisions about lending, borrowing, and investing. For example, if market interest rates rise, FTP ensures that the cost of funds reflects this change, encouraging divisions to adjust their pricing strategies accordingly. There are different methods to calculate FTP, including pooled, matched maturity, and marginal cost approaches. The matched maturity approach is the most common, aligning the cost of funds to the specific term and risk profile of the transaction. For example, a 5-year loan would be assigned a transfer price based on the market rate for 5-year funding, ensuring accuracy. In summary, funds transfer pricing is a critical tool for banks to measure the profitability of their business units, allocate costs fairly, and manage interest rate risk. By assigning a cost to funds used and a credit for funds provided, FTP ensures transparency, encourages efficient resource use, and helps banks adapt to market changes. It is an essential component of financial management in modern banking.